Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is Alec Young, Managing Director of Global Markets Research at FTSE Russell. We are talking about factor and smart beta investing today, which is one of the fastest growing areas of the ETF market. In fact, assets in ETFs that follow these strategies now exceed $1 trillion. Alec, welcome and thanks for joining us.
It's my pleasure. Thanks for having me.
So factor and smart beta ETFs, basically in simple words, they seek to combine the best of active and passive investing. They seek to outperform the market while keeping costs low, and they follow rules-based, transparent index methodologies, at least most of them. So for our listeners who are not very familiar with these strategies, would you please explain what is factor investing, what is smart beta, and is there any difference between the two?
Sure. Well, I think factor investing, as you said, is really trying to isolate individual attributes of groups of companies, groups of stocks. So a popular factor is value, looking at a bunch of valuation metrics and trying to identify the stocks that are most compelling from a valuation perspective, price to book, price to earnings, dividend yield, things like that, price to cash flow. Those would be value. Similarly, if you want to focus on very high quality, quality is another factor. Momentum is a third factor. At FTSE Russell, we tend to focus on 5. The other 2 would be high dividend, which is always popular in this era of low
interest rate, yeah.
Low interest rates, yeah. And I think the 5th one may be escaping me. It'll come to me. But basically, you're just a factor is just focusing in on a given investment attribute. And usually there are several metrics that are quantitatively analyzed to target that attribute. So if it's valuation or quality or dividend, rather than just looking at one metric for each company, the quant models will look at 3 or 4 to sort of give a more diversified view of the picture for that attribute. And smart beta is really just a derivative of factor investing, where you're taking this universe of stocks that meet your predetermined criteria, and you're building an investment vehicle around that, whether it's usually an exchange-traded fund, an ETF. And so smart beta is really born out of the idea of beta being just passive indexing, owning a broad market, and smart meaning identifying the attribute that you want. So that's where the smart beta comes from. But, a value-oriented ETF or quality-oriented or high dividend-oriented or low beta-oriented, those would all be examples of smart beta. So there's a lot of overlap between smart beta, which is sort of the popular marketing term, and factor investing, which is maybe a little bit more of the quantitative academic term. But they have many similarities between them.
And do you like the term smart beta, or do you prefer calling it strategic beta or alternative weighting methodologies? Because if smart beta is smart, then what is beta? Is it dumb beta?
Yeah. Well, I think they're all acceptable. It depends on the context. In a marketing context, in an ad, in a magazine, smart beta is going to be utilized in more of an academic, corporate context. People with more sophisticated audience, people may use things like multi-factor or alternative beta. But so a lot of it is just catering the language to the specific audience that you're talking to. But essentially, these things are all talking about the same thing, which is basically leaving the market cap weighted index, which is obviously beta and very cheap, and looking to target attributes. So in that sense, It's more active, like active management, but because it's rule-based and predetermined in advance and there's no portfolio manager sort of at the wheel of the investment, the costs are much lower than active management. So it's a little bit more than passive beta, but much cheaper than active. So anything that fits that description can be called smart beta, factor investing, alternative beta, multi-factor. Multi-factor just means you're combining several attributes. So maybe you want to combine value and quality, or you want to combine low beta and high dividend yield. That would be a multi-factor product. So once you get familiar with the terminology, you realize that a lot of this is just, fine-tuning the language to suit the situation that is in front of you.
And you mentioned some of the main factors that are used in these strategies. So they are basically value, momentum, quality, dividend, and low volatility.
And yes, low volatility.
In fact, low volatility ETFs were very popular last year, particularly earlier last year. In fact, the iShares MSCI Minimum Volatility ETF, ticker symbol USMV, was one of the top asset gatherers last year. Quality ETFs were also very popular in 2019. iShares MSCI USA Quality Factor ETF, ticker symbol QUAL, and the one by Invesco, ticker symbol SPHQ. They were also very popular with investors. Now, talking about performance of these factors, have you studied the performance, and do you think these factors can produce persistent risk-adjusted premium over time? And are there any factors which have delivered better returns historically, consistently?
Well, I think individual factors generally involve trade-offs. So you're isolating certain attributes that you view as favorable, so a high dividend yield or low volatility or high quality, but there are trade-offs. So in a very strong market like we've been in, where markets are going up a lot, the low volatility products will underperform. They tend to be popular when investors anticipate increasing volatility, weaker returns. They'll gravitate there. Investors in low volatility products are willing to give up some of the upside for more stability in case there's a correction. So it's a lower speed limit type of equity product, and no one should be describing these products as guaranteeing any kind of performance or anything. There are trade-offs with all of these factors. Over the long run, the French academic work did show a premium for value and small cap and size. That was the fifth factor that I was having trouble thinking of, size. So basically taking a Russell 1000 universe, a large cap universe, and tilting it for size a little bit. So making it a little smaller than a Russell 1000 or a market cap weighted or an S&P 500, making it a little smaller. But that's different. A size tilt, factor tilt, is different than small cap. But anyway, the academics identified that investing over the long run in value and small cap did produce a higher return. Because you were taking on more risk in the case of small caps relative to large caps, so it made sense that you would earn a risk premium, a higher return for that added risk. I think there's some truth to that, and that's why most investors do include small caps in their overall asset allocation. That's quite widespread. With value, there was also a return premium. Investors tended to chase hot growth stocks, and people that were more patient and bought the value stocks outperformed over time. But however, those academic studies are quite dated now, and with technology being very heavily featured in the growth indices relative to value, that's more of a style conversation. Growth and value are styles, not factors. Value is a factor. We don't view growth as a factor, but value's underperformed for a long time. So I think investors shouldn't assume that. Think of factors just like active management. You have to be in the right factors at the right time. Just because you buy a bunch of factors doesn't mean that you're going to outperform a market cap weighted index. Otherwise, everyone would do it. And just like it's difficult for active managers to beat the market, it's difficult for investors weighting factors to outperform the market cap weighted indices. All you're doing is guaranteeing yourself a pure exposure to the given metrics that you've identified, whether it be size, assumptions. There are always trade-offs. In certain environments, certain factors do better. In other environments, other factors do better. So I think for most investors, what makes the most sense as the core of their portfolio is still the low-cost beta market cap-weighted index, and they can accentuate factors as satellites around their core portfolio based on their views of the more tactical, short-term market environment. But I'm not sure that I would recommend replacing a market cap-weighted approach, a low-cost approach for the typical individual investor with a factor-based approach. It's something that I think for individual investors works best as more of a satellite type of thing. Institutional investors, there's more flexibility, but even there, they like to move very gingerly and slowly because they know that if they underperform the market cap weighted benchmark, they have career risk there. And so generally, everyone moves very quietly and slowly away from benchmark passive investing. When they try new things, they do them small first to see if they work. If you go all in with an active strategy and it doesn't work, then that's a very easy way to lose your job.
So as you mentioned that the core portfolio should be cheap, market cap weighted, broad.
For most individual investors, that would be the only caveat on that statement. I obviously can't speak for every investor situation, but for retail investors, I think that's the best advice.
Sure. And as you mentioned, that factors are usually cyclical. Certain factors work in certain market environment. They are according to the macro trends. So instead of using single factor strategies, should investors focus on multi-factor strategies in their portfolio? Do multi-factors ETFs make more sense?
Yes, but you have to know when to be in the right factors. So again, it just comes back to active management. How is that different than picking individual stocks?
Mm-hmm, mm-hmm. Yeah,
and that's not easy, as we all know. That's why people began indexing in the first place. So exactly. I don't think it's prudent for most investors to go trying to time factors and throw out a market cap weighted approach. There's a lot of nuance to this. I don't like to make generalizations.
Okay. And one of the things which I always recommend to our listeners and our readers is that whenever you select an ETF, make sure to look under the hood and understand the methodology. So there are many multi-factor or even single-factor ETFs that follow rather complicated indexing strategies. So if the strategy is simple and transparent and you understand, then only you should invest in that ETF.
Yeah.
Now, could you tell us?
You can also start slowly too. So everyone's comfortable with the whole concept of market cap weighted indexing. Mm-hmm. So you can move a little bit of money into a factor that you think you would be comfortable with and see how it goes, and they adjust from there. So investors should remember they don't have to do everything all at once. A nice way to introduce a new strategy into your portfolio is to move in incremental steps.
Could you tell us a little bit about factor performance in 2019? So at the end of 2018, we saw a very steep market drop. And so that is why in the beginning of 2019, investors were rather cautious, and strategies like low volatility and quality were very popular. Later in the year, and particularly in December, because it was totally risk on sentiment in the market, so probably momentum did better than other strategies. Tell us a little bit about the performance.
Sure. Well, some of the trends you mentioned held up throughout the whole year. So quality was really the star of 2019. Through up markets, down markets, quality was the best performing major factor, and value really underperformed. So it tried, as interest rates bottomed in the summer and started to move higher. Financials tend to do better in a rising rate environment, and they have a very big weighting in the value factor, sector weighting in the value factor. So as rates started to rise, value was outperforming. But again, with the momentum of technology in December, value was not able to maintain that improvement. So finishing out the year, value was weak. Again, this is after many years of relative underperformance, not only against growth, where investors often look at style and growth versus value, but also against the other factors that we're talking about. Many of the leading technology momentum stocks are also screening well for quality. So, for example, a company like a Microsoft, yes, it screens well for momentum, price momentum, but also for quality, low debt, things like that are some of the metrics that are part of the quality screen. And a lot of the large tech companies do screen for that. And that's really been the big leadership sector in 2019. And so I think that really helped some of the more sectors that had more of that technology exposure, and some of the more defensive factors, not just value, but also high dividends, didn't do quite as well.
Yes, technology was the best performing sector last year. It was up more than 50%. So quality ETFs that have a lot of exposure to technology companies, they did really well. And in fact, ESG ETFs too, they have a lot of exposure to technology companies because big tech companies, they have low carbon footprint and they usually follow socially responsible practices. So many ESG ETFs also outperform the broader market because of their high exposure to technology. Now, looking ahead to this year, which factors should investors focus on in 2019? Which areas of the market you find attractive?
Well, I think one thing that's interesting is from a macro perspective, investors are hoping that global growth, which has been quite weak, is bottoming out, and we've seen signs of stabilization in the leading indicators in Europe and China, so there's a hope that the global growth picture will improve or at least not get worse. And so I think cyclical sectors have been leading the market over the last few months. So it's very important when you look at factors to look at what's the sector composition. And with most of the ETFs, you mentioned the transparency, it's fairly easy to look at their industry breakdown, but have a look and see, am I buying more defensive, counter-cyclical industries like telecoms or healthcare or consumer goods, consumer staples, or is it more cyclical like industrials and consumer discretionary and technology and communication services, financials, and so sectors can be a helpful way of getting a sense of what's in the strategy. But I think there's reason to believe, given the macroeconomic backdrop and the feeling that perhaps the worst of the trade impasse is behind us. Certainly, many outstanding issues still to be resolved between the U.S. and China on trade, but I think there's a feeling that there's a de-escalation or the uncertainty around trade has peaked. So that would also be positive from a pro-cyclical growth perspective. So I think factors that have greater cyclical exposure at the sector level seem to make sense. So that would include right now momentum, because cyclicals are doing better, so they tend to be momentum reflects what's working. So I think momentum, quality has, as we talked about, a lot of technology and communication services, which is the new sector that houses things like Facebook and Google. Those are areas to look at, and then but the cyclicals tend to be higher beta, so low volatility products may not do as well. Generally, what tends to happen is in a risk-on environment when the markets are more optimistic about the growth outlook and the earnings outlook, you tend to see things like quality, momentum, size doing better. And then in a risk-off environment where people are worried about recession, slowdown, they want to hedge the cyclical risk, the economic risk in the market. You tend to see low beta, low volatility, high dividend type of strategies do well. They tend to have more of the counter-cyclicals, the utilities and the healthcare and the consumer staple stocks there. So there's a cyclical bifurcation among factors, just as there is among traditional sectors.
So that makes sense because of the pickup in global growth. Cyclicals are likely to outperform defensive areas of the market, at least in the coming months. So it makes sense to focus on momentum, quality, and those factors. Any other areas of the market you find attractive? You mentioned about value underperforming for the past many years, and now some investors are concerned about stretched valuations of stocks. So, do you think value can finally get its groove back in 2020 or
Well,
no?
I think interest rates are very important to watch. And at FTSE Russell, we don't really make forecasts, but we look at quantitative relationships and try to inform investors to make the best decisions they can based on those relationships. And we've noticed that as interest rates have been falling, value has been underperforming. There's a correlation there. So when interest rates started to try to rise from about 140 on the 10-year Treasury back up towards 2% in the last few months, value has tried to do a little bit better. And that's because financials tend to do better when the yield curve is steepening and interest rates are going up, their margins expand. And so you really need to have a view that interest rates are going to go significantly higher to think that value will outperform. Also, you're getting much less technology, which in this era is a difficult recipe. So I think value these days is more, when value is doing well, it's keeping up with growth. It's very difficult for value to outperform growth. Now, that's more of a looking at value through a traditional style lens rather than a factor lens. But with value, you're really getting a lot of financials. You're getting energy. You're getting utilities. These are generally not leadership areas in a risk-on environment. Financials have been doing better, but again, it's really, they haven't been doing better than tech. They've been doing better than they were before, at the beginning of last year, but they're still underperforming technology. So, this emergence of technology now, technology and communication services, which, as I mentioned, houses a lot of the big social media companies. That now accounts for 30% of the U.S. market cap weighted, the Russell 1000 market cap. So that's not growth or value or any factor. That's just the market cap weighted index. So this tech revolution is really showing itself in the DNA of the stock market. And so that makes it difficult for factors that go out of their way to avoid technology to really do well. And that's one of the risks of saying, well, historically value has outperformed, therefore I'm going to put all my money in value and I should outperform. That hasn't worked for many years, and it's because the nature of the economy is changing. So the nice thing about market cap weighting is that you really capture the evolution of the economy and the markets in the index. And so some things do better, some things do worse, but you're participating all the way. When you make too big of an active focus, whether you're using a factor or an active manager, and if your bet is off, if you're wrong for whatever reason, you run the risk of underperforming significantly. And that's what's been happening with value. And given that it's because of a lack of technology ownership, it's hard to see that changing for a prolonged period of time. Sure, valuations can get a little frothy and technology can underperform for a few months. We see that every year. But it's hard to see that theme falling apart for 5 or 10 years. Again, this is why I generally tell most investors not to try to be timing these things. And I think market cap weighted indices really make a lot of sense for people that don't have the time or the expertise to try to figure out, what's going to be the hot area from one month to the next.
Yeah, that makes a lot of sense. And another trend which we have seen in the past few years is that U.S. stocks have significantly outperformed other international stocks. And one of the reasons in the past few months was that international stocks were more affected by trade wars. And also U.S. dollar has appreciated against all other major currencies in the past few years. Do you
Yeah.
think international stocks, developed or emerging markets, they can do well in 2020, or U.S. stocks will continue to outperform them?
Well, yeah, no, I think there's room for international stocks to start being more competitive on a relative basis. I mean, they do make up about half of the FTSE All-Country World universe. Half of the global market cap is outside the U.S. So, it's important to be globally diversified. Most of U.S. investors aren't going to have half their equity portfolio in international, but certainly I think a 20-25% weighting is justified. And as you mentioned, the dollar's been strong, and international returns are padded when the dollar is weak. You're taking dollars and you're buying euro-denominated stocks and yen-denominated stocks. So when the euro and yen go up against the dollar, you do better. It adds to your returns. And the last few years, as you mentioned, the dollar's been strong, and that's diluted the returns of U.S. investors in international funds and ETFs and stocks. And because the Fed has cut rates several times recently, they're now on hold, but they've lowered U.S. rates. So the premium you earn in dollars is not as great as it was over Europe and Japan a few months ago because of the Fed rate cuts. And that's stalled the dollar rally that has been going on for the last few years. It's stalled out in the last few months. The dollar's not really going down, but it's stopped going up. And so we are seeing international do better. We're seeing emerging markets do better. And also on a relative value basis, the U.S. is very good story, best major economy in the world, good earnings story. But that's reflected. The market's it's a U.S. market. The Russell 1000 is at 18 times forward earnings versus 15 in Europe and Japan. So on a relative basis, international I think makes sense. Also in a low rate environment, the dividend yields, especially in developed international markets, are higher than the U.S. The U.S. you're looking at a little under 2%, and in the FTSE in the international markets, it's above 3% across the board, especially in the developed bucket and the emerging bucket. There are individual markets like Japan where the dividend yields are lower, but for the aggregate asset classes, most of the products, international products, are going to have yields in the 3.25% range, so almost 1.5% higher than U.S. equity products. So also interesting from that perspective. So for most investors, if their international allocation has dropped because of the relative underperformance of international and the outperformance of the U.S., now is a great time to rebalance and add to international and maybe pare back, take some profits in the U.S. and rebalance back to your target allocation globally.
Okay, makes sense. That's all we have time for today. Alec, thanks again for joining us.
Thank you for having me.
Thanks for listening. If you want to learn more about factor investing and smart beta ETFs, please visit the ETF section of Zacks.com. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@Zacks.com.